So we're going to move along to the next panel, the future of ship finance, the decline of banks, and the rise of alternative financing. Pretty depressive title, but anyway, Larry Rutkowski is a well-known member to this conference, and I'm going to leave this panel in his good hands. Larry?
Thank you, Ole. So well known, apparently, they didn't think they needed to give me a name tag today. But welcome. It's still morning, so I'll say good morning. We've had a pretty interesting conference so far. I certainly appreciated listening to those two excellent panels that covered the environmental and compliance and regulatory regimes. As you can see from my gray hair, I've been doing this a little while. I remember when somebody asked me when I was early in this business, one of the things that what attracted you to the shipping business, and I said, well, one of the things I like about it is it's very market oriented. There's very little regulation involved. I just need to think back to Economics 101. Well, that's obviously changed a great deal. Another thing that has changed a great deal over my years of practice is the way people finance ships, how they finance ships, who finances ships, and who borrows the money, of course. We've got a really good panel today to tackle this bold title. We selected this title somewhat deliberately. It was an intent to be a little bit provocative. A little ironic, I suppose, that we have two long-established banks here who are going to answer the question about the decline of banks and the rise of alternative finance. But we'll get to it shortly. Let me just introduce each of the panelists. To my immediate right is Michael Kirk from RMK Maritime, very popular fellow here in New York, been doing a lot of work sourcing funds for owners. He's really familiar with the whole idea of alternative finance. Next to him, to his right, is Marcela Carpita, a partner at Watson, Farley and Williams, who's an established, well-known ship finance lawyer who can talk to us about trends in the industry. And I may pick on her a bit for her role with the Poseidon Principles as we move along today. To her right, you have Martin Lunda from Nordea Bank. I think Martin actually qualifies now as one of the deans of the shipping finance industry. Here in New York, we've known each other for longer than either of us are willing to admit. And Nordea obviously has a very, very prominent role in banking and in ship finance. And to his right, we have Paul Taylor, a managing director of Societe Generale, another major bank in the shipping space. So we think we've got folks here who can answer my questions and yours if you have them. And anything we miss, Michael Parker, who's going to be our luncheon speaker, is going to promise to address during his luncheon presentation. So let me start with the obvious, that reflected by the title of our presentation. As I indicated, we intended to be provocative. I want to ask the question about the banks. Are we really witnessing the decline of the banks? Certainly, there have been so many changes in the industry outside the regulatory sphere since the financial crisis, which is now more than a decade past. But the effects are still obvious. The banks still seem to be paying a price. The industry still seems to be paying the price. I don't think it's as easy today to call in your local banker and ask for a shipping loan. But are we actually seeing the decline of banks, or have we reached a different phase in a different state in the banking and finance industry? Paul, could I start with you?
Sure. Hi, everybody. Well, there's certainly been a huge shift in the financing landscape. It's largely gone to the east, so that a lot of the lending banks have clearly left. And those that have left, though, it's not really down to or due to capital adequacy issues. It's because the ones that have actually left the market have gone because they've made huge losses with flawed strategies. So there's less European banks around. There's more Asian banks around. So yes, the landscape's changed, and has it changed forever? Yeah, probably. the actual Basel IV changes that are going to take place are going to change it further. It's going to make this herd mentality that we've seen in this industry, it'll mean that it does not work. You have to have more than just a lending capability, I think, going forwards. Otherwise, banks they'll disappear from the sector. Because if you could think about the teams as individual divisions within banks, these shipping finance businesses, they need to justify the allocation of capital for their business, and they're in competition with other business lines. And unless they're making profit, that word that sometimes we forget exists in shipping, unless you're making actually a profit, you're not going to be given the capital going forwards. So what's important going forwards is to be smart with your capital. You can't just lend money for lending's sake. You've got to have advisory, capital markets, hedging. You need a full toolbox to actually make money going forwards, and with Basel IV, that will be accentuated. So yeah, it's changed for good.
Now, you mentioned flawed lending strategies is one of the reasons banks lost so much money and have pulled back, perhaps, less important than capital adequacy. What were the flaws in those lending strategies?
Well, I think if you look at I don't want to mention names, of course, but if you look at the banks that have left the industry due to losses, a lot of those have lost money supporting their local ship owners through structures which really relied on a one-way journey in terms of this bubble that was never going to burst within the shipping industry. So, the KGs, for example, it was a one-way bet. Everyone thought, and then of course when it went pop, no one was prepared, and everyone had huge market risk. So, my personal feeling is that in ship financing, we should not be taking residual value risk on ships. That should be for a ship owner to take. We shouldn't be taking naked market risk, but that is a strategy which many ship owners were taking in years gone by, and most of them paid the price.
There's a lot of interesting individual thoughts there, but before I pepper you further with questions, Martin, how do you feel about the original question, and what about Nordea's, position? Nordea has certainly been one of the most prominent banks in this arena. How do you see it?
Yeah, well, kind of in line with my picture in the program, I'll quote Mark Twain: "The rumors of my death is greatly exaggerated." So, of course, the banking picture has changed very much. We have seen a lot of banks exiting. But we are also seeing quite a bit of activity in the banking sector. So we saw, last year, I think we saw above $60 billion in marine finance syndication taking place. So if I look at, just as a data point, if I look at our activities in 2019 versus 2018, we are up significantly in dollars raised for our clients. We are up significantly in transactions that we have done for our clients. So, and when I look at our pipeline going forward, I also see a number of transactions. So maybe that is because there's less banks in there, but Nordea certainly as a lending bank, we're seeing quite a bit of activity on shipping. And as Paul says, I think one of the biggest changes that, well, one of many big changes, but one very big one is the discipline that we have to adhere to when it comes to using the bank's capital. We don't get to use the bank's capital unless we provide a sufficient return on that capital compared to other departments. So the transactions that we engage in, they do have to provide sufficient capital. They do have to go through a rigid model. They have to show that we can provide a rate of return, and we get checked that we do so going forward. So yes, we are able to make money. It is very helpful to have auxiliary products, because every revenue stream we get on the client helps us justify the use of capital and use more capital. But it is really the return on the investment from the bank side is just as important as the credit risk. I mean, the credit risk is, of course, ultimate, But if we don't have the return, it doesn't matter if it's a great deal. We have to have the return to do the business. I think that, you know, and if I look at the type of transactions that we're engaging in these days versus maybe before, and this comes back maybe to points we'll make later, is that the type of borrowers we are engaging with have changed significantly over the few years. And just as an example, since Christmas, we have closed 3 major transactions for ship owners, but they're all large companies. These happen to be 3 public companies, but there's also some private companies that we deal with. But the red thread is that we are working with large companies that have access to capital, that have professionals in their management teams on, you know, compliance, KYC, ESG, and these are key metrics for us when we evaluate transactions. And maybe we'll get to the ESG question later.
Yeah, I think we will. We heard a little bit about that this morning, so we won't avoid that. And if I forget, just tap me on the shoulder. But you know, you mentioned the importance of return on your capital, on your lending, not just the sole focus on risk. But is that any different today than it was 20 years ago? Certainly, return was always important.
Yeah, but I think that years ago it was more like you had much more flexibility within your portfolio to say, I can do a low-yielding transaction here and do a high-yielding transaction here. Now every transaction is measured on its own merits. Plus, I think the models are much more sophisticated in terms of allocating risk than they were. So I think, you know, you know, if you go back 20 years, if the ship was really nice and new, you know, that was considered low risk. Well, today, you know, the ship is sort of secondary security. Today, it's the repayment capacity, the leverage, you know, there's a number of boxes that we have to go through, including ESG, that determines the risk and that determines the capital. So we're much more sophisticated than we were 20 years ago.
I think there was a herd mentality 20 years ago where big was beautiful. The bigger your portfolio, the better it was. And I just don't think that is the way today. It's about being asset light, and that will drive the profitability, because lending's sake, it doesn't make any sense.
It's interesting that you use the expression herd mentality, because I think that's something that's infected the industry across the board, whether it was you know, the latest thing the shipyards were producing, or you know, a movement in the BDI, and all of a sudden there were a whole bunch of new bulk orders coming in. And we can talk about capital adequacy and how that all relates to the availability of money, and perhaps limiting or putting constraints on the herd mentality on owners. But Marcelo, let me ask you, as a lawyer, you get to see whatever comes across your desk, right? So you may be doing something for Société Générale one day, Nordea the next, and then you might be working with one of these many alternative finance providers. Can you make an observation, and it's a little bit of an unfair question, but can you make an observation on trends as to what you're seeing? Are the banks pulling back? Certainly there are fewer banks you're working with now.
There are certainly fewer banks, but there is still bank financing, and I think it still remains like the main source of financing for the ship owners. I agree with Paul and with Martin that the banks need to be more sophisticated, but still we see a lot of banks. Of course, we have seen Chinese leasing, we have seen alternative finance as well, but I think that there is one difference, if I may put it this way. I think that there is a factor for bank / ship owner, and that is the relationship. And I think that this drives a lot of decisions for banks, whereas I'm not sure if the relationship factor can fall into the alternative finance or non-bank capital or financing, if you wish. because it is more asset-driven or transaction-driven, or I don't know if this is something that it's mainly factored in.
Thank you. And Michael, I don't want to ignore you. You're forced to wear several hats today, as sort of a proxy for alternative lenders. You know, what are you seeing? You're probably busier today than you were pre-financial crisis. Tell me.
Yeah, I think that's right, and busier on different products. But I think there's two buckets of alternative financing. There's sort of the just replacement of the banks on first mortgage debt, and then there's sort of hybrid products as well, where you're sort of working with the existing lenders. And I think we're starting to see those kind of meld together, and we're seeing borrowers that might have, you know, alternative financier for a part of their portfolio, maybe the older ships, and still have, you know, the traditional banks in there for a large portion of their capital. So I think the kind of the interesting thing is that it's not an either or, and I think that there's going to be more kind of working together, more collaboration, and we're going to see it look like other sectors, like aviation, you know, like real estate to some extent, where you just have a kind of menu of options depending on where you are in the cap structure, what type of assets you have, and I think that's, you know, I think we probably thought we were going to be here 5 years ago, and I think we're now getting to that, and we're starting to see that happen, and I think 5 years from now, you know, there'll still be, it's not going to be called alternative finance anymore. There's going to be 5 or 6 different buckets that people slot into.
You don't have to name names, but if you could, how would you sum up the availability of alternative finance, the nature of the institution that's there to provide it?
Well, theoretically, it's a very big number, but you know, the actual dollars going to work are still relatively small, and I think they're small, you know, in absolute terms, and small to the opportunity set. I think one thing that we've learned, you know, we have people that sat in Martin and Paul's seat, and that has been hugely important. I think trying to do alternative lending to shipping, you know, everyone sees the opportunity, everyone sees the returns, but it's a lot harder than I think people realize. And you see the people that have done it successfully, almost all of them have people that have sat in, you know, a traditional lender's role and done those types of loans. And so that's, I think, part of the reason we haven't seen the capital deployed that you'd expect, is people get into it, think it's a great idea, and then just pull back when they realize, actually, this is a lot harder than they realized. So I think that's starting to change too. And again, I think this is something that, you know, maybe not in the next 12 months, but over the next 24, 36 months, we'll see larger deployment pools on the alternative side that are run by people that have significant shipbuilding experience.
Does that mean that there's a home for all the ex-bankers who've worked at those institutions that are not represented up here at the table any longer? But you, I think, alluded to in your initial remarks what I would call the place of the banks and the place of all alternative finance in the capital structure. So longer term, you see alternative finance at a different place in the capital structure than just a replacement for senior debt, or do you think it's going to be all of the above?
I really do think it's going to be all of the above, and I think it's just going to depend on the situation. There are certain borrowers that, you know, aren't going to be viable candidates for these guys, and they'll be just regular way first mortgage loans being done. Then there's companies that a certain portion of their assets are going to fall outside of the bucket, you know, and it's maybe an LTV thing. So they can get 50% here, but they want 65, and so they're going to go somewhere else. And then I think there's going to be, you know, just going back 10, 15 years ago, 70, 75, 80% was the norm on first mortgage debt. That's clearly not the case anymore. So then there's that whole kind of 50 to 75% range that might not be first mortgage, but I would still consider to be, you know, debt financing, so, you know, alternative financing, so to speak.
The pricing gap's got to change, because otherwise there's a lot of talk about alternative finance. Every conference I go to, we talk about alternative finance. But at the moment, the bank's pricing model works. Maybe it won't going forwards after Basel IV. But unless there's this huge reduction in the gap between bank pricing and alternative lending, is the senior debt market really going to go to alternative lenders?
I think that's right. There's this really interesting kind of no man's land, you know, where you have people, if they can get double-digit returns, that makes sense for them to do the loans. The problem is if the asset's going to have a 9-10% return, it's really hard to pay your lender in excess of that. And there's this kind of no man's land, which I think is sort of between, 5 and 8% kind of unlevered, that still makes sense for the borrower, especially if he thinks he's borrowing his asset right. And that's what's been, slow to fill. And there are people that are doing it, and I think as people get larger, it makes it a little bit easier for them to do that. And then again, there's the whole thing of, and it's been talked about a lot. I don't think it's happening a ton, but I think, again, over the next 5 years it will, where you see, lending, banks that are maybe lending to some of these alternative financiers and kind of creating a two-tier structure within those kind of vehicles. And that maybe helps bridge that no man's land, which certainly exists today. Yeah.
One of the topics we haven't talked about at all, and we don't have any representatives specifically of private equity up here, but it's my sense, and you all may have a different perspective on this, but that the private equity, to the extent it's still coming into shipping, is coming more into lending funds than it is direct equity investment. If that's right, and you can tell me if you think it, otherwise, that does put a fair amount of burden on ship owners to come up with the kind of equity and the level of equity commitment they need in order to be able to get the funding from a bank or an alternative finance provider in order to get your traditional ship mortgage debt. So, Paul and Martin, if somebody comes to you and they're not one of your big public clients, and they say, well, we've got this proposal where we can manage our costs by getting senior mortgage debt from you and a subordinated tranche from somebody else at a little higher rate. Are you willing to even look at that sort of thing, or is it just so far from afield from your model that it's a non-starter?
Yeah, no, we traditionally won't look at that. It's it creates, sort of a additional risk in the capital structure when you have a lever like that, and unless it's extremely deeply subordinated with no voting rights, no exercising of powers, we tend to shy away from it, quite honestly. So we dabbled in this, 15 years ago. We tried to establish, like a mezzanine sort of tranche. But I think the trouble is that when you split up the senior and mezzanine debt, inherently the mezzanine debt return has to be much higher, because the senior, you are at a much more exposed position than if you have controlled the whole capital picture, right? Because then you can control your destiny. So when we see structures like that, we tend to shy away from them.
We don't see very many of these, but I certainly wouldn't provide the subordinated tranche, or the mezzanine. Not a chance. It doesn't work from a capital perspective in the model. The return would have to be absolutely huge to merit taking that as a bank. But certainly the senior debt, we can look at playing that role.
Michael, what have you seen? Have you seen any of these types of transactions?
Paul was saying there's all these alternative finance panels at these conferences, and that's right. I think what's missing from the conferences is sort of the equity, in the sense that there used to be PE panels all the time, but that's really gone away.
Yep.
And so it's people's own capital, shipping companies and ship owners' own capital. And so what we're seeing is when they really want to make that acquisition or they need to make that refinance that's sort of over and above where they go, typically they're issuing, rather than debt, which is difficult to make work with the senior debt, they're typically issuing, some kind of preferred equity, usually that pays someone a coupon, they get their money first, and then they get a significant upside split as well. And that's just a function of the market and the capital that's available.
It's the availability of capital that I'm really driving at and trying to get to sort of your prototypical transaction. Because if I'm hearing, Paul and Martin correctly, they're looking at a narrower universe of potential borrowers, and while Marcella says there's still a fair amount of bank activity, anecdotally, and I think the league tables say this too, there's less bank capital going into shipping, at least from the Western Hemisphere, right? And so if it's really hard for somebody to to come up with the right package that's going to get them bank financing. If they can't come up with that equity, is that lack of capital ultimately going to change the industry even further so that the larger public companies, or maybe a really large private company, become the norm, and the smaller companies and the 2 and 3 ship financings are just a thing in the past, all wax about eloquently over a beer at the bar?
There's always going to be small private ship owners, but I was asked a similar question 2 weeks ago in London. And, you know, personally, we haven't gone to ESG yet, but because of ESG, because of increased regulation, the successful shipping company going forward, I think, will have a very different look to the one which we've all known in the last 20 years, and the herd mentality again. We know about that. I think we're going to be seeing a company with strong corporate governance. We're going to have transparency, all these words which you just don't hear in shipping over the last decades. But that is the future. And I think, answering your question, it's going to be the larger companies that really benefit. So if there's winners and losers, in my opinion, the winners will tend to be larger, maybe public companies, have transparency, strong corporate governance. There'll be more consolidation, and because of that, or not because of consolidation, because of transparency and strong corporate governance, there'll be greater access to banks, greater access to capital markets, and as a result of that, they're the ones who'll come out, I think, in a stronger health, and it'll be those that still stick to yesterday's prehistoric formula of secrecy and non-transparency, who I think will disappear.
Marcella, is this your experience as a lawyer looking at the industry?
Yes, I was going to say that, I may sound romantic, but I also think that there will be a shift from the public markets to the private sector, and I think that we will go back to basics, to the traditional Greek and Hong Kong ship owners, if I may say that, and we will also see equity coming from the countries that are under development right now, like India and China.
I think, just to put it a little perspective, is if I look at the customer types I saw 25, 30 years ago versus what I see today, we have a complete change in our customer groups. We have gone from where half the portfolio were the private little ship owner to the larger corporate and private style entities, and I think it will be like capitalism. I think the problem is that the smaller companies will have to pay more for their capital, and over time they probably cannot afford and compete, and then they will sort of be fewer and fewer of them left. But of course, private ship owning companies with access to equity, maybe equity finance or very low leverage, they will exist. But it's just, I don't think you can compete like for like in the capital structure between private and large companies.
Although although there's finite capital around for shipping finance and for the shipping sector, I think that there may be less ships in the future. This whole environmental...
Which is not necessarily a bad thing, right?
Which I think is a great thing. And this whole environmental push that we're all experiencing, we're all seeing, is going to lead to more consolidation. It is going to lead to less vessels on the water, because everybody's waiting and seeing at the moment as to what tomorrow's fuel is going to be. Then no one's investing in new ships, or not many people. And that actually could serve the industry quite well.
Since we've heard a lot about this, and some of you seem to be itching to talk about ESG, let's talk about ESG. We heard some interesting remarks this morning about that and its importance, and it strikes me. I'm laughing in a little bit because I actually got a letter from an investment advisor last week, not one I happen to use, but it happens to be a friend of mine. And he basically wrote in his letter to his customers, in which he kindly copies me, that he didn't really care about ESG. He's out for yield, and that's what he owes his customers. But I'm hearing today otherwise from previous panels and from you. So tell me a little bit about ESG and how it impacts your business and your lending. Either one of you.
Go on, go.
Sure. Yeah, no, I think, like from our formal website, we do have a formal commitment to ESG, and we have a stated goal that we should take leadership in this process. It's part of our code of conduct, and I think the bank is a member of about 20 different organizations, ranging from PRI, that's Principle for Responsible Banking. I have to read this out because I don't know them. IIGCC, Institutional Investors Group of Climate Change, Task Force on Climate-Related Financial Disclosures, Corporate Human Rights Benchmarks. So there's no doubt about it, Nordea takes ESG extremely important, and it is part of our DNA. So what does that mean practically? Well, actually means practically that when we do a credit application, we have an ESG group, separate analyst group, that will look at our borrower or applicant for credit, and they will do an analysis of their ESG, and they will rate them. And that is part of our credit, and will be discussed in credit committee.
Not to be a cynic, but is that just so you can avoid headline risk?
No, I think it is actually a wish of the organization to be appropriate and supportive of these benchmarks. I don't think you can be a large public company today and not take ESG seriously. I think investors will actually, over time, from a personal view, I think we will come to a point where we're going to invest our own money, and we're going to have to decide: do we want a higher yield or a lower yield in responsible companies? And the way I read the world today, I think that many of us will actually choose a lower yield to be able to say that we do support ESG activities across.
I'll have to share that information with my financial advisor friend.
No, ESG is super important. I won't repeat everything, but if you take the Poseidon Principles, which I know you'll want to talk about, but this is central now to our lending policy. We're one of the sort of founding signatories, along with Citibank and DNB, who signed the Poseidon Principles. And this actually will bring climate alignment, climate risk into our credit decisions. And what does that mean? It means we will measure the carbon emissions of any vessel which we're looking to finance. So if it's a refinancing, we'll measure them in advance, and we may or we may not go into that financing if the vessel is not aligned. But we're making a commitment not only to be transparent and publicly disclose the emissions on our portfolio, but we're actually having to change our business and our strategy in ship finance in order to keep ourselves aligned going forward. So that is quite a commitment. So ESG is super, super important, and the Poseidon Principles are absolutely at the center of that.
Yeah, I'd like Marcelo to tell us a little bit about the Poseidon Principles, because there may be one or two people out there that don't know them, don't fully understand them. But I'm going to tell you right away what my follow-up question is going to be, not necessarily to Marcelo, but to anybody who wants to tackle it, which is, are the Poseidon Principles a truly meaningful attempt by the banks to enforce eco-friendly shipping practices, or is it more a cynical attempt to get good public relations and regulators off your back?
And I would love a crack at that later.
Good.
Yeah.
Marcelo, go ahead.
Please allow me to say first that Watson Farley & Williams provided legal insight and drafting input for developing the Poseidon Principles. I think it is a very important initiative, and it is evident that it started with 11 signatory banks, and we have reached 16 right now, and it's going up. Last week, we also had France's export credit agency signing up, and I believe that we're also expecting the Asian leasing houses and Asian banks to join, and if I'm not mistaken, they were also officially invited last week in London, because I saw an article somewhere that they were not, but that's also taken care of. It is a global framework which for assessing and disclosing the bank's shipping portfolios to align with IMO's trajectories and reduce GHG by 50% by 2050. I don't know if I should go into any technical detail, but I like your question on,
And Paul seems
that.
ready to answer it.
So I think that it is certainly a positive and necessary attempt, for sure. I think if you take climate change seriously and into consideration, and if you also take target, emissions into consideration, it's certainly positive. I think that it's not going to be a bank's responsibility only. I think it's going to be a global, in the global sphere. I mean, look at BlackRock, for example, last month, they announced in an open letter that they are going to take into consideration and put in the heart of their strategy climate change and sustainability. And they're going to do so by asking their firms to disclose, to have a more open disclosure, to increase their sustainability funds offerings, and by pledging to change how they actively manage their portfolios. So I think this is a very important initiative, and I think that it concerns all of us. And if I may borrow the theme from the World Maritime Forum this year, which is stakeholders capitalism, I think that stakeholders care, and seafarers care, and customers care, and I think we should all care.
Go ahead, Paul.
Yeah, so I'm responding to was it your cynical question or your question on...
I guess it was my question as to whether or not you all were cynical, but that...
No, so the Poseidon... Michael Parker is the chairman of the Poseidon Principles here, and I'm vice chairman, and it's something which we take incredibly seriously. It's certainly not a cynical attempt for banks to have some way of communicating as looking good. It's all about action, not about words. And as I said a few minutes ago, it will change our businesses. Every bank is entitled to run their business how they like, but actually, in order for us to remain aligned with this IMO trajectory that will reduce over time relating to the emissions, we will have to finance more green vessels, whether that is LNG, hybrid LNG, hydrogen, methanol, whatever. We have to do more financings of green vessels. So if we show that in our actions and support the energy transition and don't just use it as a communication tool, that cannot be a cynical attempt by banks to greenwash. Call it what you like. It really is a way of supporting this energy transition. Now, there's 17 signatories to date. 16 of those are European, plus Citibank. So if there is any cynicism, it certainly isn't in Europe. We're close to getting our first Asian signatory, and we expect that to be very soon. And it would be great if the US also had more signatories, and we hope that is the case. We have to self-regulate. And if we don't self-regulate and drive this ourselves, we'll be driven by the IMO or some other regulator, and it'll be much tougher. So what I would say is this is a really, really positive initiative, and more banks should jump on board. I do think the industry should embrace it.
Thank you. Michael?
Yeah, I think...
What about other people in the industry besides the banks? How does this affect the work that you're doing in trying to put people together in transactions?
Yeah, I think, it's going to create a two-tiered market in certain situations for ships or companies that maybe don't comply. So obviously, as a lender, we're making sure that the ship is in compliance with class, with the IMO, with all the regulatory kind of regimes that exist. But this is sort of another layer which, I think at the moment, maybe I won't be so bold to say it out loud, but I'll just repeat the sentiments of your financial advisor. And I think that is part of the way that we're looking at things. And you know, I think there's, you know, I think the goals are certainly laudatory. But you know, as we think about older ships, you know, that maybe do have a little bit higher fuel consumption, but you know, it's a big carbon footprint to scrap that vessel and then build a new vessel to replace it. So actually, you know, you could maybe make the argument that keeping that vessel around net is a better situation. So I think for us, you know, we're still focused on the quality of the operations, the quality of the borrower, and the creditworthiness, and that's something that we're keeping an eye on. But you know, I think as a small player, it's not something that we, you know, really have probably the resources to contend with at the moment. So I think we're going to be focused more on the economics.
Thank you. If I may, I'll open up quickly to questions. We have some over here in the front.
Thank you. Joe Hughes, American P&I Club and NAMEPA. In making judgments as to the ESG compliance of a particular borrower, what are the sources of information that you use to achieve that judgment?
Public documents are very integral. So we go through, you know, what the companies file when they're listed companies and what they state about their commitment to, you know, ESG.
Is there any way that you can actually go rather deeper than just what they're saying about themselves publicly?
Yeah, we do go deeper, but we don't, you know, obviously we keep that confidential, but, you know, sometimes there is a process where our analysts will actually reach out to the company and ask for more information regarding a number of issues that we have a list of things that we, you know, and it goes from, you know, from corporate governance, including to actually what they do.
And how long would that process take, typically, would you say?
No, I think it's simultaneous with, you know, when we do our financial review. So it's a quick and efficient process, but it's evolving. I don't say it's perfect today. I mean, it's something that have started up and it continues to evolve, and people get more sophisticated about it, and companies get more sophisticated about it. So, but it's definitely on our calendar.
Thank you.
Larry, may I just make a last comment, if
Sure.
I may? So I think the biggest problem in societies in dealing with environmental consciousness is the lack of uniformity. And for example, I was watching a documentary on BBC about a village in Finland and how autonomous it has become energy-wise with solar panels and wind turbines. And then you look at all these big cities like Athens and New York, where we go around with our SUVs and keep the engine on for the air condition, or take our Learjets and fly to Malibu or to Davos. Or, for example, if you take the United States, when it was growing as an economy, it had the opportunity to use coal and oil, or even every source of cheap energy. And now we are expecting the countries that are underdeveloped or under development to use very expensive sources of energy. So I think that as societies we need to be consistent and uniform. And I believe that the initiative of the Poseidon Principles is a very good example of uniformity and consistency.
Thank you.
Could you please discuss the specific risks considered for climate change adaptation rather than mitigation? So some of those things that affects, we can disagree on the science or whatever, but the climate's changing. So things such as extreme weather events that might affect shipping, or in Australia we've been experiencing a lot of fires, or in some areas eventually rising sea levels that will influence ports and other things. Could you just discuss some of the risks that you might be assessing in some loans? So if a particular loan you're giving to some infrastructure is considering the adaptation.
Yeah, well, I'm not sure adaptation has reached it yet, but we do look at, you know, the IMO 2050 statements regarding how to meet that requirement, and so we are evaluating. And as I said, it's an evolving process that we have not, you know, we're not perfected it yet. But I just want to make the point that it is part of our process formally. So hopefully, we'll refine it.
We have time for one or two more questions, or, okay, we'll make it three since there are three hands up.
A question on the whole mezzanine and senior piece where you mentioned, I mean, maybe you're not willing to do mezzanine, but maybe you're willing to back lever some of the alternative funds. But on a similar aspect of it, speaking more of Poseidon principles and lending from what the aviation side is doing with aircraft leasing, there you can literally take a chunk of the airplane and separately finance that, which is more or less impossible in the shipping industry. Do you see shipping moving in that direction? I mean, new ships will have to be more and more flexible to remain, viable in the long run. And you'll have to be able to lend specific equipment that gets attached on your ship to keep that ship upgraded over time, which most banks aren't willing to do piece by piece. But then no other lender is willing to come in and take a pure equity risk because they won't have any security on that equipment. Do you see the model of financing changing in shipping into more of what aviation is? Or?
Well, I can tell you from the legal side, the law's got a long way to go to allow for that to happen.
Look, the answer is I don't know, but the shipping finance industry is quite a straightforward, simple model. It always has been a simpler model, less sophisticated than maybe other sectors, which is maybe a surprise given how capital intensive the sector is. But, I think it's going to take a long time until it changes and you start taking tranching it in a sort of way securitization is done. Shipping, there's been very, very few shipping transactions which have been securitized. It can happen. There's no reason why not. Yes, the mortgage is different, but there's absolutely no reason why it cannot be done. But I think the model needs to change, the capital model, and I think the mindset needs to change.
Yeah, and pieces of a ship don't come apart as easily as engines off an aircraft.
Hi, Jason Tama, Coast Guard. Great discussion. A few things were said about regulators, so I'll speak as a regulator, an evil regulator. I
deny having used the word evil.
Yes. We talk about, in terms of use of force or use of our authorities to achieve compliance, we talk about using the minimum force necessary to achieve compliance. When it comes to industry, in my experience, I think there's sort of two schools there. There's what Paul articulated, which is we need to take care of ourselves, or we will have the terms dictated to us externally. And then there's the other school that I think is minimum investment necessary to meet the absolute minimum regulatory standard, and nothing more. And so you're advocating something, the latter approach, if you will, or the former approach, excuse me, with the Poseidon principles. And I think building off the question over here, is there a benchmark in another sector? Is there an analog for Poseidon principles in another capital-intensive sector or emission-intensive sector, whether it's aviation, infrastructure, manufacturing, whatever? Or is maritime kind of pushing out on its own in this space because of what's happening with IMO 2030, 2050? Is it industry on its own? Is it the regulatory framework, or some combination of the above? And are there parallels? Thank you very much.
Go ahead, Paul.
At the moment, the shipping industry is on its own. It's the first sector-specific climate alignment initiative, and I think the shipping industry should be very proud that it is the first one. There's no reason why other industries shouldn't follow suit, but shipping is very fortunate to have its own regulator, the IMO, and therefore we have this trajectory that we can measure our emissions against, and we can report the delta between our own emissions and the IMO's trajectory. So unless another sector, aircraft, oil and gas sector, has similar regulators, which it doesn't, they have to approach it in a different way. But there's no reason why other sectors can't have their own version of a climate alignment initiative. And we're aware that in the oil and gas industry, with FPSOs, for example, that discussions are already underway as to whether there's a way of measuring the emissions that are emitted from those type of assets. So I think this is the first. Well, I know it's the first, but there's actually no reason why other sectors will not follow suit.
Sorry, and to add something, and I think that as shipping banks are setting the example, this can be viewed also as a positive influence inside the institutions for the other sectors that the institutions themselves have, like other sorts of transportation, aviation, or offshore.
One last question.
But just to follow up on the question, there is no, like the banks that do business outside of the shipping industry, none of those departments of the banks apply the kind of criteria that you're applying to the Poseidon principles to the shipping industry. Is that correct? From the bank side, I understand the regulator side, but from the bank side, are they going to the people in the power industry or the energy industry and saying, hey, here's what we've, similar criteria to what you're valiantly doing in Poseidon?
From a sector-specific perspective, no, we're the only one. However, from a bank perspective, there are other initiatives. There's the Principles of Responsible Banking. There's the Katowice Agreement. There's the Paris Agreement, where countries and institutions have made commitments relating to climate change and to measuring emissions. So at a macro scale, macro level, these commitments are being made. Discussions are taking place within the organizations. But in terms of divisions, individual businesses, shipping is the only one. In fact, within Société Générale, where I work, it's very, very high profile. And of course, it's given other business lines something to think about. You could have said we've given them a bit of a headache because they realize it's coming.
Great. I want to thank the audience for being engaged with this panel and our subject, and I'd like to thank my panelists, Paul, Martin, Marcela, and Michael, for doing a great job today. The only other thing I want to say, or two things, but they're related, I really was quoting from an investment advisor, not from me, and two, I drive a Tesla.
Thank you, Larry. Thank you for a good discussion. First of all, I'd like to thank Navios for filling us up with caffeine earlier today. And now I'd like to thank Liberian Registry for filling us up with wine at the reception, the pre-luncheon reception outside. So we'll see you for lunch out there. Thank you.